Good morning and happy Wednesday. So sorry I'm not there today, but I am at a PCC meeting virtually, actually. I'm in the building, but just on a Zoom meeting. So I don't want us to fall behind, so I want to go over all this with you. I apologize, the video will be about 15 minutes long. Today we have a lecture, 2 ed puzzles, a discussion board, and an assignment. We do not have a financial tip of the day. I want to make sure we get going. All right, today, like I said last class, we are going to be talking about introduction to credit and how to build a credit score. Credit score is incredibly important. It's just as important as, say, a social security number. A credit score can open doors for you, and a bad credit score can close doors for you in your life. So today we're going to talk about what is a credit score, and then we're going to go over just some basic terminology with it. And then I'll try to do my best remotely here to make sure you understand how to build a good credit score. All right, there are several different types of debt that you can get just in life. You can get debt through auto loans, credit cards, mortgages, HELOCs, which are home equity lines of credit, student loans, and just other types of debt. Medical debt would fall into that other category. Currently in the United States, actually it's a slightly outdated number. I've not been able to find more current data. But currently in the United States, consumers have about 16.9, almost $17 trillion in consumer debt. Mortgages are going to be the largest area for debt simply because the price tags of a home is pretty expensive. Obviously, your age is going to depend on the type of debt you have. And the average debt per household is about $124,000. That sounds maybe low. However, when you think about all the people in the United States, 18 to older than 70, that could be quite a bit. So, when we look at debt by age, if you look at this category, 18 to 29, you can see here they have a lower rate of people just as a group of group of individuals in a category or age range that have mortgage debt versus if you go down to the 70 plus, 60 to 69, maybe even 40 and over, 40 to 70. All these people have really high mortgage debt, right? They are more established in life. They have more income. They are probably earning more money. Therefore, they can afford probably larger mortgages. HELOCs, that home equity line of credit, those are basically second mortgages on a house that allow a consumer to purchase items, especially larger items, that otherwise maybe they couldn't. And they're using their home as collateral. And I'll talk about collateral debt here in a minute. But let's say I have the Rambergs own a home and we do have a HELOC on our home. And let's say we decide we want to do a remodel. Then I can go to the bank and I can pull money out of this account that's a HELOC and then borrow against the house to do that remodel. The benefit to doing that is I'm using that money while I'm borrowing against the house. I'm also improving the value and increasing the value of the home. Most people after a scenario like that would get the house reappraised and just simply increase the value of their home and then slowly pay off that extra loan. Some people might need to borrow against their house to pay off large medical debt. There's lots of big ticket items people might choose to borrow against their house for. Student loans, you can see 18 to 29-year-olds, they have the higher rate of student loans, which makes sense because as a life stage, that makes sense compared to high student loans for 70-year-olds. All right, have you ever borrowed money from anyone or have you ever lent money to anyone? Did they pay you back? How many of you have not been paid back for borrowing or lending out money to someone? That's super annoying when that happens. And in a scenario like that where it's just friend to friend, if you don't get your money back. The repercussion of that is maybe the friendship is, it breaks a little bit. Maybe it frays a little bit. You don't have maybe a ton of legal recourse, especially for a $5 loan. But in today's lesson, we're going to talk a little bit more about what would happen if we are borrowing larger amounts of money and we're using the bank to do so. Which takes us to this slide where we are looking at 3 important terms to know: principal amount, interest rate, and term of the loan. With the principal amount, that simply is how much money are you borrowing for something. So let's say I want to borrow $5,000. Maybe I'm taking out a car loan. So let's say I'm taking out a car loan for $5,000. That $5,000 is the principal amount. And then every single time I make a payment, the payment goes towards that principal amount until I don't owe on it anymore. However, we also have to calculate in our interest rate. And the interest rate, borrowing money is not free, and that is just, bank loans is one of many ways a bank makes a lot of money. And they make money through charging you interest for borrowing. So if I have a $5,000 loan and I have a 5% interest rate, every single time I make a payment, I'm going to pay 5% of $5,000, and that amount is going to get paid to the bank first, and then the leftover money from my payment will then slowly be applied to my principal amount. That's why sometimes it takes a long time to pay off a loan, because of the dang interest. You also have a term of a loan, and a term of a loan is simply like how long do you have to pay on this loan. Banks do it by months, so they will say a 24-month or 36-month term. So let's say I have a $5,000 loan with a 5% interest and a 24-month term. That means I have 24 months to pay this off. If I want to pay off this loan in 15 months, I absolutely can. There is no penalty if you're paying it off early. In fact, you simply are just giving the bank less interest if you pay it off early. So paying off your debt early and saving yourself a lot of money that otherwise would have been paid towards interest and putting money in the bank's pocket, pay off your loans early, it's a good thing. All right, secured loan and unsecured loans. A secured loan, a great example of that, is that auto loan we were just talking about, because that is connected to what we call collateral. And if you default on a secured loan, then the bank can repossess that item. So I have a $5,000 car loan. The bank owns it, actually. I get to drive it. I get to make payments on it. I pay the gas. I pay the interest. I pay the insurance. I pay the maintenance. But I don't own it. I don't own it until I'm done paying that car off. The bank does. And if I default on that loan, if I just decide, I'm done paying, the bank says, great, I'm going to go ahead and come get that car. We're going to take ownership of it. We're not going to give you any of the money back. Thank you for your payments. Now, no thank you. You are no longer a client. So when you do that, that is a great example. If you don't make your payments, that's a really good way to lower your credit score. If you pay off your debt and you make every payment on time, that's a great way of increasing your credit score. Unsecured loans are loans that aren't connected to collateral, and if you default on them, the creditor can't come take your stuff away from you. So if I have a credit card and I charge a bunch of shoes to it, and then I stop paying on the credit card company can't come and take all those shoes, as an example. The consequence for that, and students always say, well, why wouldn't I just charge a ton of things to it and stop paying? One, it's illegal. Two, it will absolutely demolish your credit score. If you are it's illegal in the sense that if it was a regular habit, you can't do that. That's a big no-no. Other unsecured loans would fall into student loans, and then any type of personal loan that you have, whether that be with a bank or, maybe even family or friends. All right, credit scores. Credit score range goes from 300 to 850. 300 is really bad. My nephew had a credit score of 0. Come to find out, no credit score is worse than bad credit because there's just no history to even look at to see how responsible or irresponsible he was. Credit scores really determine quite a bit. If you have a bad credit score and you try to go get insurance, like, for example, car insurance, odds are you might be paying more for that car insurance because they're going to assume that there's a correlation there that maybe you're also a irresponsible driver. That may not be true, but there are correlations there. If you have a bad credit score and you want to go get a job that requires you to have good credit, a lot of banking jobs will pull your credit score. If you have a bad credit score, it's quite possible you're not going to get that banking job. Because if you can't manage your own money, they don't want you managing other people's money. So, high credit score is going to open more doors. If you go get a loan, likely you will get a lower interest rate. You will get a higher amount of a loan. You'll get higher limits on credit cards. More doors for employment if credit score is related to employment for you. Those doors will open, and you'll just be eligible to gain other debt that you might want or need to take on. Versus a low credit score, those doors are closed. And again, the way you build a credit score is being consistent. So if you have a credit card and you make regular payments on it, and you don't max out your credit card limit, that is one way that you can increase your credit score. My very first credit card, the limit was $500 on it. I think I maxed it out probably pretty quickly, and then I had to pay it off. And then I really worked at not getting it up past $300. So I would try never to owe more than $300, and I'd always try to pay it off right away. Paying off your credit cards and keeping low balances is one really great way to increase your credit score. Having a lot of credit cards and owing a lot of money on all those credit cards is a great way to lower your credit score. Let's see. Your bank accounts won't affect your credit score. And medical bills, as of 2021, Biden put into law that if you don't pay a medical bill, it used to be that if you didn't pay a medical bill, that you would get reported to the creditors, you'd be turned over to collections, and that it would really negatively affect your credit scores. Medical debt in this country is the number one reason why people claim bankruptcy. Back in 2021, Biden signed into law that no longer is that possible. So you can still claim bankruptcy over medical debt, and they can report it to your credit, but it can't negatively affect your credit score anymore. So that is a positive for consumers. Let's see. So medical, banking, those can't overly really affect your credit score, but paying on your student loans, paying on auto loans, making sure you have a credit card to slowly and safely start building those credit scores is a positive thing to do. I know some students in the past, I know it's a practice we're doing in our house, is we're giving our kids credit cards, and we are co-signers on those credit cards and slowly building up their credit. So that way they don't, they're doing it safely, and they're not just, running around crazy with these credit cards. All right, and I mentioned a minute ago being a co-signer on a credit card for our kiddos. A co-signer is a person who agrees to pay a borrower's debt if you default on a loan. And again, don't forget credit cards are a form of a loan. That could also be an apartment. So let's say you have really bad credit and you really need to move out and live on your own. If you don't have good credit, it's likely that you won't get approved to live in an apartment on your own. But if you have a co-signer that says, you know what, like they've had some missteps, but they're on the right track, I promise, I vouch that they will make their payments, and if they don't, I will take care of it for them. Then the co-signer can step in and help out with that. Now, if you default on it, that financial responsibility and burden does fall on them, and you don't want to fray bridges or ruin relationships over money, so just be careful about when you're grabbing co-signers to help you out. All right, there's two different types of rates, a variable rate and a fixed rate. A variable rate means exactly that. It means the interest rate can change over time. It can change to month depending on what's happening with the economy. A fixed rate is it's the same exact rate the entire time or the entire term of the loan. So for example, if you have a mortgage for 30 years and your interest rate is 5%, your payment will be exactly the same for all 30 years. Versus if I have a variable rate on that same mortgage, it might be 5% this month, it might be 10% next month, it might be 8%. In our current economy, there's been a lot of housing stories, especially of younger couples who had variable rate mortgages to get into their first home. Then the economy kind of tanked, interest rates went really high, and their mortgage payment, one couple I was listening to in an interview, their payment went from like, I want to say $1,600 a month to like $3,600 a month. It was a $2,000 increase in our mortgage payment for the month, and that really financially devastated them, and it was they had to make some really hard decisions on how they were going to move forward in that situation. All right, this Canvas discussion, this is just that discussion board with some vocabulary. You can get to this when I'm done here. Again, there's going to be some items on Canvas. Let's go over and take a quick look. So, over here, again, do each of these ed puzzles. You can work with other people. The intro discussion board, just copy and paste these suckers into the reply, answer in your own words. And then lastly, you're going to do this FICO credit assignment. And this is an assignment understanding how to build a credit score. So the first scenario is Sam. And Sam, he's a junior in college and he's turning 21 and he's super excited to get some more credit cards because he thinks the more credit cards he has, the better. That's not true. And here are some details about his current profile. So your job is just to read this profile. I was doing this on a video a second ago I recorded for you that you won't ever see. All right, Sam currently has 3 credit cards. Do you think that's a good thing or a bad thing? I kind of think, maybe bad. He got his first credit card 8 months ago. I think it's kind of bad that he got 3 credit cards in 8 months. That's probably not super great for him. He doesn't have any student loans. That's probably a good thing. So we're going to give that a plus. I'm going to go down to number 10, and I'm just going to give pluses or minuses. And of course, I'm going to be talking to my table mates to see what they think as well. Then I'm going to take a stab at this and say, what do I think his credit score is? I haven't gone through all these scenarios, but let's say I think his credit score is going to be 700. I don't know. You guys decide what you think it's going to be. Then after that, I'm going to actually go through this estimator and see, based off of his scenario, what his credit score is. So based off of my answers, I am going to go through these scenarios and click these answers, and at the very end it's going to give me an actual credit score for Sam, and I will put that right here. Then I'm going to finish answering these questions, go through the same scenario with Jessica. She has her own stuff going on. I'm going to give pluses or minuses in this column as well. Then I'm going to also do the estimator for her. And then I'm going to go through Danielle, who is debt-free. So when you are done with that, you will submit that to Canvas. So this assignment actually probably won't take you terribly long. And I will say over here, 1, 2, and 3 probably combined, maybe 15, 17 minutes. All right, friends, have a great day. I'll see you Friday.